I am so glad you are here for this part of Unit 4. This is where everything that we've learned in Unit 4 starts to come together. So let's have an enormous sequence of graphs so that we can see what monetary policy looks like in the real world. Oh, you're going to love this. All right, so by now we already know that there's a difference between a limited reserve system and an ample reserve system. The U.S. used the limited reserve system until the financial crisis of 2008, but after that crisis we turned to ample reserves. Ample reserves means the reserve requirement is 0. But we still need to learn the limited reserve system because it's possible they use those tools. Other countries might use those tools as well. All right, we're going to begin then by looking at expansionary monetary policy. When you're looking at expansionary monetary policy, I could be looking at the limited reserve system or I could be looking at the ample reserve system. In limited reserves, we're going to start with that. In limited reserves then, remember that you're going to use open market operations, which means that we're going to buy bonds. So remember, we're going to associate the B with buy with the B in bigger. So if we're trying to make the economy bigger, we're going to buy bonds using the limited reserves system. That's what's going to fix the recession. Here at the top across the entire board is the sequence of the graphs that I'm going to draw out. The point is, whether it's a limited reserve system or an ample reserve system, you are going to see a change in the nominal interest rate. So whether or not you're using the money market or the reserve market, that change in the nominal interest rate is going to lead to a change in interest-sensitive spending. And remember, this is huge, the spending sector that borrows the most is IG. Gross investment borrows more. Nike borrows $10 billion. You go to the bank and borrow $20,000. So even though C does borrow, we're going to focus on IG being what the activity is you're going to see in the macroeconomy. Then that's always going to change aggregate demand. If C and IG change, aggregate demand has to change. You're going to see the change in real output, which is the x-axis, and the change in the price level, which is the y-axis. This is great. All right, we're going to begin with the bond market. So what I'm going to do is I'm going to draw, and I would like you to draw also because that gives you an opportunity for practice. So the bond market is a basic market, which it means upward sloping supply curve, downward sloping demand curve. This is the price. And then because I've named this the bond market, I can just put QB for quantity of bonds. I'm going to go ahead and create an equilibrium. So price 1, quantity 1. So what happens when the Federal Reserve is buying bonds? If the Federal Reserve is buying bonds, that means bonds are going to leave the market. The market represents the flow. The market represents activity with the public in the flow, and it represents activity with banks because banks also have bonds. So what does this mean for us? If the Federal Reserve is going to buy bonds, that means that the supply of bonds that's available in the market is going to decrease. My supply curve is going to shift to the left. So S1, S2. Anytime there's less supply, you already know that prices go up. So now I have a new equilibrium. The price of bonds increased, and clearly the quantity of bonds that were available in the market decreased. So that is the activity that we're going to see in the bond market. This then leads us to some new information. So right here above the arrow, I am going to write, because there was an increase in the price of bonds, I'm going to see a decrease in the interest rate in this next model. So the relationship between bond prices and interest rates is inverse. Make sure you memorize that. Okay? Supply decreased in the bond market because bonds leave the flow or the bank, and go to the Fed. Perfect. Those bonds are now both out of circulation and out of the banking system. So now let's see what happens in the money market, because how am I going to get that interest rate to come down? So now I'm going to draw the money market. Remember, in the money market, you have the vertical supply curve because there's never a relationship between the y-axis and the supply of money. Remember that we label the y-axis the nominal interest rate. This then remains fixed unless the Federal Reserve changes it. So QM, because I've already identified that this is a money market, remember you have to draw the liquidity trap with the demand curve. So it starts vertical because this represents transaction demand. Then it starts to become inverse. That represents asset demand. And then it flattens out and cash becomes trapped because no matter how low the interest rate goes, some people are never going to borrow money. So here is my equilibrium. Great, interest rate 1, quantity 1, perfect. But I have had activity because in the bond market, these bonds left the flow, left the banking system, and went to the Federal Reserve. What did the Federal Reserve send back to the flow and to the banks in exchange for those bonds? M1, money. So I have to see activity in the money market. What happens? The supply of money shifts to the right. I have now increased the supply of money. So supply of money 1, supply of money 2. I probably should put demand of money 1. And now look what happens to my interest rate. Oh my gosh, this is exactly what I want to see happen. My interest rate came down. So now I have validated this relationship. But the point is we're going to use this decrease in the interest rate to affect a change in interest-sensitive spending. If I have seen this decreased interest rate, I want to motivate C and IG to spend more. That's the point. Where is that going to happen? Not in the money market. This is in the Federal Reserve. Remember, that's completely out of the flow. So there has to be another market here. Now we're going to go to the federal funds market. This one's brand new. We haven't drawn this one yet. So with the federal funds market, this is what happens. You now have the federal funds rate, but we're going to call it a real interest rate. It's a regular market, positively sloped supply curve, negatively sloped demand curve. Let's create that equilibrium. So interest rate 1, quantity 1, quantity of federal funds. Recall that federal funds are the funds by law that each banking institution has to keep as cash at the end of the business day. Otherwise, the bank has to, by law, close its doors. It goes out of business. The Federal Reserve doesn't want to see that happen. So if banks need to borrow from each other in the federal funds market, what's going to happen to the interest rate? Oh, nominal interest rate went down in the money market, so then how is that going to affect the federal funds market? This one's kind of tricky, so I want to pick a good color for this. Here, what I want you to remember is Fisher's hypothesis. So you have a decrease here in the nominal interest rate. Remember, Fisher's hypothesis says that the nominal interest rate is equal to the inflation rate plus the real interest rate. And that's going to play out once we get to the macroeconomy. What I know for sure happened is that because I don't have any information on inflation in these models, I'm going to say that inflation is 0. I don't have any information. I can't possibly factor that in. So if the nominal interest rate went down, so does the real interest rate. How does that happen? Well, I've increased the supply of funds that are now available for lending between banks because there's more money in the banking system. M1 left the banking system when the bank sold their bonds to the Federal Reserve. Ah, so exciting. So now, I know that I have a decrease in the nominal interest rate, and because I don't have any information on inflation, I have a decrease in the real interest rate. Who loves that? Who thinks that's just great? IG, we're trying to motivate, we're trying to incentivize IG to spend more. So now we're going to go to the macroeconomy. Okay, so remember, this could be the name of a country, or it could just be nation, or you can put macroeconomy. So now we have to switch to price level to capture all the prices in the economy. This, of course, is real GDP. Then I have to have my long run curve. Then I have to have my aggregate demand curve. What's important with this, though, is that I want to make sure that I am going to be creating a recession. So I don't want to be in long run equilibrium. So I'm actually going to draw my short run aggregate supply curve over here. I'm going to say this is my first point of being in equilibrium, so PL1. Of course, this is YF. I'm not at YF. I have a negative output gap when I have a recession. I'm trying to get to YF. How am I going to get to YF? The interest rate went down. Who loves that? IG. So what am I going to see in this model? I am going to see IG is going to borrow more. So here I'm going to see a shift of aggregate demand to the right because I increase my interest-sensitive investment spending. So because that's aggregate demand activity, I now have this rightward shift. Look, I'm back onto the long run. How beautiful is that? Wow, we fixed this recession, didn't we? And I'll tell you, when you hear stuff like that, you're back onto the long run. When you hear stuff like that, it is real life. So this type of activity would have helped fix recessions before 2008. This is not what we used for COVID. We went to ample reserves for COVID. But this is how the Federal Reserve does it. Okay? So now, and I have a little bit less space here, but we're going to make it work. We're economists. We're efficient. So what did I see happen? I saw that there was a decrease in the real interest rate. That led to an increase in IG. What I want to do here then, in this very last space for you, is to draw a Phillips curve model. We haven't learned the Phillips curve yet. We will learn that in Unit 5. But here's the point. Let's show you what that looks like because we're finishing out this sequence. So in the Phillips curve model, I don't have a lot of space here, so I'm going to actually draw an arrow going down a little bit. This x-axis gets the label of the unemployment rate. And because it's a rate, remember it's always a percentage. This y-axis, because we deal with price along that y-axis, this is going to then get the inflation rate. And of course, it's still a rate, so it gets the percentage sign. We have a long-run Phillips curve. This long-run Phillips curve, though, gets the intercept of NRU. You know that the natural rate of unemployment is between 4% and 6%. And then we have this negatively sloping short-run Phillips curve. Okay, because I began in a recession, I'm going to show you where point A is going to be on the Phillips curve model. So I'm just going to pull this over and call this point A. How do I know that it's point A? Because I'm closer to the x-axis, my unemployment rate is higher. So if you want, you can think of this as 0. If I am here, I am definitely beyond the natural rate of unemployment. That is showing me that I am in a recession. So then we use the symbol pi for inflation, as you know by now. we're going to go ahead and pull the symbol pi into the inflation rate along the y-axis for the Phillips curve. Here, I want to definitely be sure that you're aware we don't use I. Once again, I is only investment. So make sure that you're not just putting an I there, because that's going to be incorrect. So make sure you use that pi sign. So point A then shows me that I have recession because I'm at U1. I'm to the right of the natural rate of unemployment. What I want to do is be at the natural rate of unemployment, because when I'm at the natural rate of unemployment, I am at full employment in the macroeconomy. That's my goal. So then what happened? That lower interest rate led to an increase in aggregate demand, which then brings me back into the long run on the Phillips curve model. So this is now my inflation rate, and clearly I'm back onto the natural rate of unemployment. So if this is point A, this is going to be point B. And that's how the Federal Reserve fixes a recession. How great is that? It works. Okay? We love that. Now what I have to do, though, is I have to show you the reserve market, because we just finished showing you what happens when we use the money market and ample reserves. We could use the reserve market also, but luckily I don't have to get rid of all of this. What I'm going to do is I'm going to start where the federal funds market is. So I'm going to go ahead and erase this and show you what's going to happen if we're using the reserve market. So the reserve market is more commonly used with the ample reserves system, but you can see what the federal funds rate looks like with limited reserves also. All right, so we got rid of most of that. Here we go. This then is going to be the reserve market. We are still working with limited reserves. So I'm just going to call this reserve market. But I'm going to make sure that you know we're dealing with limited reserves, because I'm going to compare that with the reserve market and ample reserves. So this is going to be important, because you saw that limited reserves uses open market operations. We were able to influence the federal funds rate. Right here, you know that this means you saw a decrease in the federal funds rate. That is an open market operation. Nothing happened with ample reserves, because open market operations don't affect ample reserves. So then what is this going to look like in the reserve market? All right. So this is the new graph that I've talked about a few times already. This is the policy rate. And the quantity is going to be reserves. That's why it's so important to tile your graphs, because it really helps you answer graphing questions. All right. I always draw the funky demand curve first, and then I put the vertical supply curve, because remember, this one has 3 parts. So it's weird, right? So that top portion is the discount rate, then this middle portion is limited reserves, inverse relationship, and then it flattens out. Once we get to the horizontal portion, you're back in with ample reserves. So here, I'm going to call this demand for reserves. With limited reserves, because I am targeting the federal funds rate, I'm actually going to put the vertical curve of supply somewhere to come into this negatively sloping portion. So let's say that I put it there. Okay, so this is going to be supply of reserves. Sorry, you can't see that very well. Okay. With ample reserves, it has to go in the flat portion because that's where ample reserves are. So this is where this goes. All right. So what ended up happening? Well, I'm going to say, let's not use red, it's a little smeary. I'm going to say that originally this was my interest rate. But instead of using the intercept for policy rate, I'm going to use the federal funds rate because that's going to allow you to see that this is a limited reserves market. All right, so this is going to be my federal funds rate, number 1. Okay. Well, I have a federal funds rate going on with here. No, because you only see federal funds rate when you're talking about limited reserves. Here, I have the policy rate. So this is going to be policy rate 1. All right. Then I increase, because of virtue of buying bonds, I increase the amount of reserves that are now available in the economy. So now I'm going to come back over and go through the flat portion of the demand curve. So supply of reserves 1, supply of reserve 2. I have a new lower federal funds rate. That's exactly what you saw happen in the federal funds market. Perfect. That's exactly how that's supposed to work. Because we don't deal with federal funds here, nothing happens to the policy rate. The policy rate is equal whether you're at policy rate 1 or policy rate 2. Nothing happens because this market, being ample reserves, is not going to react to changes in the federal funds rate. However, this activity turns into this all over again. So you haven't missed anything if you're using limited reserves in the reserve market, but it's not the same as using the reserve market with ample reserves. Okay? All right, well, now what I want to do is bring you into the world today. So if you're watching this video in the fall of 2022, you know we have inflation. Oh my goodness, we're so concerned about inflation. What does that mean? I have to pursue contractionary monetary policy. So yes, that means that I'm going to do this entire sequence backwards because that's what's really happening in the world today. Oh my goodness, so many graphs. All right, let's do it. Make sure you're writing these down because that's what helps remember. Perfect practice means your brain can later recall this physical activity and you'll be able to retain this information much easier, okay? So don't be afraid to practice, practice, practice. That's what makes you get good at doing it. All right, so now I'm going to go ahead and continue with this sequence, nominal interest rate. If it changes, leads to interest-sensitive spending, changes aggregate demand, changes real output and the price level. The difference is I have to change the word expansionary. We are no longer trying to make the economy bigger. When you have inflation, you have to make the economy smaller. So let's go ahead then and get rid of expansionary and put contractionary. Now we're going to pursue contractionary monetary policy. We're still using limited reserves, but now we're not going to buy bonds. I don't want more money in the economy. I want less money in the economy because I don't want people spending as much. So limited reserves needs to become less available. We don't want banks making loans to people. So I'm going to sell bonds, and as you know, take the S and sell and associate it with smaller economy, because what we're trying to do now is fix an inflation. Okay? The good news is, because we've already done the graph sequence, I'm going to move a little bit faster and not explain the inverse relationship in the bond market and things like that. You're already aware of that. So we do go back to the bond market. Draw this out. Help your brain. Good old-fashioned supply and demand. Remember, it's just price and the quantity of bonds. So P1, Q1. All right. Now, if I'm going to sell bonds, well, that's going to change the game, isn't it? If I sell bonds, that means that more bonds leave the Federal Reserve and enter the market. So the supply of bonds is going to increase. So the supply curve in the bond market is going to shift to the right. Guess what happens when there's more supply? You already know the answer to this. Prices go down. Now there's more quantity of bonds in the flow and in the bank. So here, bonds leave the Fed and go to either the bank or to the public in the flow. This contracts M1 because you have to send your money to the Federal Reserve for them to send you the bond. Okay, money market. You know what's going to happen here. So the price of bonds went down, interest rate goes up. Money market. Oh my goodness. This is what is going on right as we speak today. And I know that you might not be watching this video with high inflation because it changes. It can change in just a few weeks. So that's kind of cool too. Economics is very dynamic. Okay, so here's my supply curve. Here's that funky demand curve. And this time, I'm going to put M first. So either one is fine, SM or MS, DM or MD, however you prefer, but make sure that has that liquidity trap. That's a terrible way to lose a point. Okay, so interest rate 1, quantity 1. Well, clearly, there's less cash in the economy because the bonds left the flow and the bonds left to the bank, and they're at the Federal Reserve now. So in the money market, there's just less money. So then the money supply curve shifts to the right. Pardon me, shifts to the left. What happens? Less supply, interest rate goes up. You know that. Prices always go up when there's less supply. Oh no. But how's she going to get people to stop spending? Then we had activity in the federal funds market. So remember, bank to bank. Good old-fashioned market, just supply and demand. This, though, is the real interest rate. Don't forget, you're not in the nominal interest rate anymore. You have no information on inflation, so you're going to say that if the nominal interest rate goes down, the real interest rate goes down. So now there's less money in the economy. There's less money in banks. So the supply of loanable funds shifts to the left. The interest rate in the loanable funds market increases. It's going to be more expensive for banks to borrow from each other. And if it's going to be more expensive for banks to borrow from each other, it's definitely going to be more expensive for you to borrow from the bank. Oh boy, let's see if that really ends up happening. It does. So now that higher interest rate means that our friend IG is not happy. They are not going to borrow as much. So then in the macroeconomy, so you have price level. And you notice these graphs. It's not about making your graphs beautiful. It's about making your graphs correctly. So as long as you have all the requirements, just draw away. Look what I did there. I drew a money demand curve. We don't want that in there. Let's get rid of that. All right. Short run aggregate supply. because I'm starting with an inflation, wow, I'm going to have my aggregate demand curve pretty high up. So I'm going to pull it across this y-axis. So I clearly have a higher price level. And then I have this positive output gap because Y1 exceeds YF. Remember, if you think of YF as a number line, when you have a positive output gap, that means you have lower unemployment. So even though this is good because more people are working, we're trying to fix inflation. We want those prices to go down. Remember, everywhere inflation is a monetary phenomenon. Everybody that lives in a country is affected by inflation. You are not directly affected by unemployment unless you personally have lost your job. Now, there'll be indirect effects, but a direct effect, no, not with unemployment. Inflation directly affects everybody, so we don't want it to be too high. All right, so then, because I've increased that increased interest rate leads to a decrease in IG. They don't like it. I'm not going to borrow, it's too high. So then aggregate demand is going to shift back down to the left, which means I have a new equilibrium point. Sure enough, price levels come down. That's my goal with inflation. Now, oops, unemployment's gone up. Maybe I had an unemployment of 2 to 3% at Y1. Now I have unemployment back to 4 to 6%. But the goal was to bring those price levels down, and we were able to accomplish that. Last one. So then the last one that we're going to draw is the Phillips curve. Now, with the Phillips curve, they like to ask about this. Make sure you write out inflation rate and put your percentage sign. There again, terrible way to lose a point because you just put inflation. Inflation is here in this model. This is the inflation rate. Those are two different things, okay? So short run Phillips curve, let's make that a long run curve. Long run Phillips curve, short run Phillips curve, the natural rate of unemployment, and then once again, because it's very wordy, let me go ahead and just pull down here for unemployment rate. Well, in this case, I am starting out with a higher inflation. So I'm going to say that my inflation rate is here. This is where I'm starting. So inflation rate 1, unemployment rate 1. So do you see here where your unemployment, when you have the higher price level, your unemployment is lower than the natural rate of unemployment because so many people are working? But then once that decrease in the interest rate leads to that decrease in aggregate demand, once that happens, I'm going to bring down that price level just like I did here. And I'm going to be back onto the long run just like I am in the macroeconomy. The difference is my trade-off is an increased unemployment. Oh my goodness. Yeah, real life. And it changes very frequently. Think of the business cycle. In the history of this country, we've already had 20 recessions. So it's just going to happen every few years. All right, I'm going to erase all of this because I'm not going to show you the comparison between the ample reserves and the reserve market with the limited reserves with the federal funds market because we just did that with expansionary. And I think you guys get the idea there. But I do have to show you definitely ample reserves with the reserve market because that's what we're dealing with today. All right? So let's go ahead and get rid of all of this and start with a clean slate. What I'm going to do here is actually just erase this section because I don't want to think about limited reserves at all. We're just going to focus on ample reserves and show what it looks like with expansionary policy and show what it looks like with contractionary policy. And that's all we're going to do, and then we're done. And you guys are amazing. Explain this to your parents. They will love it. They'll be like, oh my gosh, I never understood what the Federal Reserve was doing. And now I do. And my child explained that to me. I think that's so great. All right, I'm going to come back over here. We're going to have expansionary ample reserves. Then I'm going to compare that with contractionary ample reserves. And you know what's interesting? I mean, I go into the slideshow on why the Federal Reserve switched to ample reserves. So revisit that if you don't remember. But this is way easier. And they thought it was way easier too. So in fact, the way we do it today is a lot easier to learn. So just good old-fashioned X and Y axis. Here, I'm going to call this the policy rate. I'm going to go ahead and add in parentheses that when you're dealing with ample reserves, it's administered. It's not a federal funds rate like limited reserves. Who administers the policy rate? The Federal Reserve. You know what they do? They don't go to the bond market to buy and sell bonds. They just say, the interest rate today is 2.0. Okay, we're good with that. They're administering it. Easy. So we don't have to do the bond market. We don't have to do the money market. We don't have to do the federal funds market. So it's an administered policy rate. Because you already know that, I'm not going to repeat it. Let's just put policy rate, because this is really how you would label. Then, because it's, let's go ahead and add market, just to be safe, because that way I can just pull that down here. So because I've identified it as reserves, I'm just going to put QR on both of them. Okay, we're going to start with that funky demand curve. That one's not really good, but it'll work. That one's a little bit better. Okay, so here, it has to be in this flat portion. So supply of reserves, demand for reserves. So here, the only thing that's happened is the Federal Reserve, if they're trying to fix a recession, they are pursuing expansionary policy. What they're going to do is say we're now lowering the interest rate, so this is going to fall. People are going to borrow more, and because we have to create an equilibrium, we're going to pull that across. That's it. Well, that's a lot easier than having to draw the bond market and the money market and the federal funds rate. Boom, done. Okay, over here then, it's the same thing. Make sure you're in this flat portion. So here, I have the supply of reserves. And this is going, and these rates are usually really down very low on this y-axis. So policy rate 1. This is what's happened today. We need to increase the interest rate because that's going to disincentivize IG and C from borrowing. So, well, that's just about going to leave that flat portion. So I don't like that because we want this to be just perfect. When it comes to drawing your graphs, and you're supposed to be in a certain position on the graph, make sure that you are. So this is the supply of reserves 1. Now that interest rate has gone up, there's just less money in the economy, period. So I just wanted to capture that flat portion, and I wasn't able to do it with the first position that I had drawn. Interest rates go up. This is fall 2022. Next fall may not apply at all. That's how the Federal Reserve does it. Makes your life easier while you sleep overnight. Get your degree in economics. Change the world. That's all I have for you. Bye.